Most people think gold is a bet on fear. That is the first mistake. Gold is not a mood. It is not a superstition. It is not a shiny object people cling to when they get emotional. Gold is what you reach for when you realize the floor beneath every dollar asset is not concrete. It is a fault line. And what the Federal Reserve just did was not a minor adjustment. It was not some technical operation meant only for bond traders and economists hiding behind polite language. It was a shift along that fault line. If you own gold, silver, stocks, bonds, retirement accounts, rental property, or simply a life priced in dollars, you need to understand that shift before the rest of the crowd feels it under their feet and starts running. Because by the time the panic becomes obvious, the prices will no longer be kind. I have spent most of my life studying incentives, capital flows, the stories institutions tell when the truth is too uncomfortable to say directly. And I can tell you this much. When a central bank changes the words it uses, it usually means it cannot change the math it is trapped inside. That is where we are now. The Federal Reserve told the world it was fighting inflation. It told the world it was tightening. It told the world it was reducing its balance sheet and pulling back from emergency era distortions. It spent years building the image of a disciplinarian. Then, quietly, it began purchasing treasury bills, again, at roughly $40 billion a month, and dressed it up in a phrase that sounds clinical, harmless, almost boring: reserve management purchases. That is what I call the reserve mask. The reserve mask is the first mechanism you need to understand. When a man tells you he is borrowing because he is investing in his future, maybe that is true. When a government creates new money to buy its own debt and tells you it is just managing reserves, the language is not there to clarify the act. It is there to soften the act. In plain English, if you create money out of thin air and use it to buy government obligations, you are supporting the debt market with money that did not exist before. You can polish the label all day. The mechanism does not care. And mechanisms run the world. What matters to me is never the public sentence. It is the cash flow underneath the sentence, the incentive underneath the cash flow, and the pressure sitting underneath the incentive. That pressure is the second mechanism. Debt gravity. The United States is now carrying debt on a scale that changes behavior all by itself. Not just political behavior, monetary behavior, institutional behavior, market behavior. When debt is small, policy still has room to pretend. When debt becomes monstrous, policy stops being ideology and becomes arithmetic. You do not need a dramatic imagination to understand this. You need a legal pad and a willingness to stare at ugly numbers without blinking tens of trillions of federal debt, roughly 9 to 12 trillion rolling over across a short time horizon. Interest costs already above $1 trillion a year, and a central bank that, in its own bizarre way, has been paying more on reserves than it earns on lower-yielding bonds accumulated in an earlier era, leading to massive cumulative losses that would have destroyed any ordinary institution. A normal institution cannot lose hundreds of billions, invent a softer accounting phrase, and move on. A central bank can. That does not mean the losses are unreal. It means the consequences arrive through credibility instead of bankruptcy court. That is the thing most people miss in money. Credibility is balance sheet capital. A grocery store can survive embarrassment if the cash register still works. A central bank can survive accounting games only as long as people still believe it is choosing its path rather than being dragged down it. That is why debt gravity matters so much. Once the debt load reaches a certain size, every policy choice starts bending toward the same destination. You can speak about shrinking the balance sheet. You can speak about low rates and discipline and normality. But if the market is not willing to absorb the debt at acceptable yields, somebody must step in. And every central banker in history, when placed between abstract purity and concrete systemic stress, has picked the printing press with better manners, not because they are fools, because they understand that letting the bond market fracture creates an immediate visible disaster, while devaluing the currency arrives more slowly and can be explained away for a while. That is the third mechanism, the credibility crack. I want you to picture a dam from a distance. It looks solid. Tourists take photographs. Officials stand in front of it and talk about its strength. The water behind it looks calm enough, but somewhere inside the concrete, hairline fractures begin to spread. At first, those fractures do not change the shape of the structure. They change only the truth of the structure. That is where the monetary system is today. The reserve mask tells you the public language is shifting. Debt gravity tells you the arithmetic is closing in. The credibility crack tells you the old promise that policy is firmly in control and moving according to principle is starting to lose force. And when that happens, gold stops being a commodity story and becomes a trust story. That is the entire point. Gold is not competing with a productive business over who creates more value. I would rather own a wonderful business than a dead metal in a healthy system. But when the system itself begins asking for more belief than the arithmetic deserves, gold changes category. It becomes reserve truth. That is why the official sector has been buying it at a pace that should have made ordinary investors pay far more attention than they did. More than 1,000 tons a year for multiple years. Not social media traders, not frightened retirees, central banks, sovereign institutions, the largest, slowest, most politically informed pools of money in the world. I want you to think carefully about what that means. These are not people buying because a candle on a chart broke out. These are institutions with teams of economists, diplomats, and risk officers quietly deciding that a portion of what used to be safely stored in dollar claims should be moved into an asset with no counterparty, no keystroke risk, and no dependence on another country's permission. And that shift did not begin by accident. It accelerated after the United States and its allies froze Russian reserves in Fay. I understood the strategic logic of that move. I have also understood the message it sent to every other sovereign balance sheet on Earth. If reserves can be frozen by political order, they are not neutral reserves. That one realization changed the reserve management logic of the modern world. I call that mechanism the sovereign exit. The sovereign exit does not look dramatic from the outside. It is not one nation screaming rebellion and dumping dollars in a single afternoon. Institutions of that size do not move like a stampede. They move like elephants crossing a river, slow enough to seem calm, heavy enough to alter the riverbed. That is what official gold buying has been. A controlled exit from total dependence on a system that can be weaponized. The public saw gold moving higher and asked whether retail enthusiasm had returned. That was the wrong question. The right question was who is accumulating while nobody else is paying attention. That is almost always the right question in markets. Now, the difficult part, and the part that will confuse the greatest number of people, is that the same institutions that built phase one of this gold bull market can temporarily become sellers in phase two. That sounds contradictory only if you confuse strategic belief with immediate obligation. A man may believe in the long-term value of his business and still be forced to sell stock to meet payroll during a crisis week. His sale does not mean he stopped believing in the business. It means the fire reached his office before it reached his competitors. The same thing can happen to central banks. That brings us to the fourth mechanism, the liquidation cascade. When war disrupts energy flows, especially through bottlenecks that matter to global oil transport, the first order effect is obvious. Oil rises. The second order effect is harder and much more important. Countries that import energy need dollars, not local currency, to pay their bills. If their own currency weakens while imported energy costs surge, they come under pressure from both sides. Their citizens feel inflation, their politics feel stress, their central banks feel a deadline. In that environment, gold can be sold not because it lost strategic value, but because it retained strategic value. It is one of the few assets liquid enough to turn into dollars quickly. That is what happened when Turkey sold and swapped a large amount of gold in a short span after the regional war shock. That is not a gentlemanly portfolio rebalance. That is a sovereign margin call. And once you understand that phrase, you can understand the whole reset. Forced selling is not thesis invalidation. Forced selling is the market handing good assets to whoever still has liquidity and emotional control. That pattern repeats across history because pressure behaves the same way, whether the balance sheet belongs to a farmer, a hedge fund, or a nation. When the bill is due now, long-term strategy gets shoved aside by short-term survival. People who do not understand the seller's motive always misread the price action. They see gold fall and conclude the bull market is dead. They see central banks sell and conclude central banks change their minds. No, a foreseller has not changed his philosophy, he has changed his urgency. That distinction is where fortunes live. I have seen versions of this in every asset class worth studying. Forced liquidation creates the ugliest headlines right before it creates the cleanest opportunity. It clears leverage. It humiliates weak hands. It teaches the crowd to stop trusting the trend. Then when the supply exhausts itself, the structural buyers return to a market that no longer has excess enthusiasm in it. That is what a real reset is. Not the end of a thesis, the removal of weak ownership from a thesis. The reason I take this so seriously now is that we are not dealing with one isolated force. We are dealing with multiple layers pressing on the same fault line at once. The Fed is quietly moving back toward debt support under the reserve mask. Debt gravity keeps pulling policy toward monetization. The credibility crack is widening because the system can no longer convincingly pretend it is both tightening and quietly reliquefying the same architecture. The sovereign exit continues because central banks have already learned the lesson of frozen reserves, and the liquidation cascade driven by energy shock and dollar demand is creating the near-term selling pressure that fools ordinary investors into mislabeling the whole sequence. That alone would be enough to make me pay attention. But there is another accelerant, oil. I call it the oil fuse. Oil shocks do not merely affect gasoline. They alter the timing of monetary stress. When energy spikes, inflation embeds itself more deeply into the economy. Transportation, manufacturing, food, logistics, utilities, everything begins to feel the second derivative of that move. At the same time, growth becomes more fragile because higher energy acts like a tax on households and businesses. Now put yourself in the chair of a central banker. Inflation pressure says tighten. System fragility says ease. Debt math says yields cannot be allowed to run forever. Politics says avoid visible pain. That is not policy discretion anymore. That is entrapment. And entrapment is bullish for gold because gold is not waiting for a perfect inflation reading or a perfect recession signal. Gold is responding to a system that is losing the clean ability to defend its own credibility. Every major oil shock in modern financial history has exposed that tension. And when that tension becomes visible, gold tends to move. Not because people suddenly love metal, but because they suddenly distrust mediation. That is the phrase I want you to remember. Distrust of mediation. A bond is mediated by the issuer. A bank deposit is mediated by the bank and the state. A stock is mediated by future profits, discounted through the prevailing monetary regime. Gold sits outside those promises. That does not make it superior in all climates. It makes it irreplaceable in this one. Now I want to talk about the identity mistake most investors make in moments like this. They still think of themselves as return chasers. They ask, will gold go up this quarter? That is a small question. The larger question is, what role am I playing in my own financial life? Are you a renter inside the paper system hoping the managers keep the plumbing intact? Or are you becoming a reserve builder? Someone who understands that some part of your wealth must sit beyond the promises of any single institution. That is the identity flip. When I was younger, I learned quickly that money has two jobs. The first is to grow. The second is to let you say no. Most people understand only the first. That is why they own everything as if the only game is performance. But reserve assets are about refusal power. They let you refuse forced decisions. They let you refuse panic sales. They let you refuse dependence on perfect policy outcomes. Gold, cash, productive assets with strong balance sheets. These are not random allocations. They are forms of strategic refusal. In a world where the fault line is widening, refusal power matters more than cleverness. That is why I would rather own a slightly less exciting portfolio with multiple ways to survive than a thrilling one that depends on the continued perfection of a system already showing stress fractures. And this is exactly where most investors get seduced into the wrong move. They wait for universal confirmation. They want the news anchor, the strategist, the chartist, the Treasury official, and the Federal Reserve all to say the same thing before they act. That never happens at a good price. Certainty is the most expensive asset class in the world. By the time everyone agrees the positioning window is gone, the central banks that began buying in size after fade did not wait for certainty. They read the direction from the incentives. That is what professionals do. They do not demand comfort first. They demand coherence. The current environment is coherent. The debt math is coherent. The Fed's behavior is coherent. The oil risk is coherent. The sovereign accumulation pattern is coherent. The temporary official selling pressure is coherent. The miner's profitability, despite poor public participation, is coherent. That does not mean the path will be straight. It means the forces belong to the same story. Now let me bring in the part most people are still missing almost completely. The miners, I call this mechanism margin torque. When gold rises meaningfully above a miner's cost structure, the miner's economics do not improve linearly. They improve with torque. A modest move in the underlying metal can create a dramatic move in operating margin, free cash flow, and enterprise value. If a miner was barely earning at $2,000 gold and now earns multiples of that margin at higher prices, the business has transformed far faster than the public's attention has, and yet the crowd still has not fully arrived. That matters. Bull markets become dangerous only after the public story becomes socially irresistible. We are not there. The institutions move first. Retail still chases what felt safe last cycle. That tells me the setup has more room than the headlines suggest, especially if the fault line widens into phase 2 and phase 3. I am not telling you miners are risk-free. They are not. They carry operational risk, jurisdiction risk, management risk, cost risk. A miner can make a fool out of you faster than bullion can, but when a sector is showing record profitability, while money is still hesitating to enter, I pay attention because markets do not pay you most for buying what everyone agrees on. They pay you for understanding the mechanism before the crowd can name it. That is the whole game. You do not need to be the first human being on earth to see the future. You need to be early enough that the price still offers mercy. So what do you do with all of this? You build a fault line protocol. That is the operational blueprint, not a mood, not a vague opinion, a protocol. The first part of the protocol is classification. Stop treating every asset as if it belongs in the same mental drawer. Some assets are growth assets, some are reserve assets, some are tactical leverage, some are volatility ballast. If you mix those purposes, your behavior will fail you when stress arrives. Gold is reserve truth, silver is later, cycle torque with more volatility. High-quality miners are leveraged to the metal with company risk attached. Energy majors are partial beneficiaries of the same geopolitical disorder that destabilizes the monetary system. Utilities and other defensive cash flow assets can provide ballast when risk markets become erratic. High-quality businesses with strong balance sheets and real free cash flow remain essential. But they must be purchased with full awareness that the unit of account itself is under strain. The second part of the protocol is sizing. If your whole portfolio depends on one macro outcome, you are not investing. You are making a confession. Do not turn a sound macro view into a fragile personal structure. Own enough reserve assets that you can remain rational. Own enough quality that you can still compound. Own enough liquidity that you are never forced into the market's timing. And if you use leverage anywhere near a widening fault line, understand that you are volunteering to become part of someone else's liquidation cascade. I have no interest in that role. The third part of the protocol is time. Do not buy protection with a trader's patience. If you understand the three phases, then you understand timing in a different way. Phase 1 is institutional repositioning while the crowd still shrugs. Phase 2 is when the market realizes the central bank is not improvising from strength, but reacting from compulsion. Phase 3 is when the broader public finally understands that the old arrangement between debt, rates, and confidence is no longer stable. The biggest money is usually made between Phase 1 and Phase 2, not after Phase 3 is screaming across headlines. That is why patience here is not passivity. It is positional patience. You position, then you refuse to let short-term noise break your coherence. The fourth part of the protocol is psychological. This is where most people fail, even when they understand the numbers. When gold falls during forced liquidation, they feel betrayed. When miners do not instantly explode higher, they lose confidence. When the central bank uses softened language, they let themselves be soothed because the alternative feels too destabilizing to accept. I understand that temptation. People do not merely want returns. They want a world that still makes intuitive sense, but markets do not owe you emotional convenience. Your job is not to prefer the simpler story. Your job is to identify the true one. And the true one right now is that the Fed has already moved under the reserve mask. The debt system has already reached a point where debt gravity dominates principle. The credibility crack is widening. The sovereign exit remains structurally intact. The oil fuse is active, and the current gold weakness is at least in part a liquidation cascade rather than a philosophical rejection of gold's role. Once you understand that chain, the current reset becomes legible. And once a reset becomes legible, you can stop behaving like a victim of price and start behaving like an owner of process. That is a very different life. I have lived long enough to know that wealth is not just what you own. It is the quality of your decision-making under pressure. A man with a smaller portfolio and a coherent protocol is wealthier, in the practical sense, than a man with larger nominal assets and no idea what system he is trapped inside, because when the ground shifts, the first man acts from structure, the second acts from fear, and fear is always more expensive than ignorance. If you have listened carefully, then you already know the final choice. You can keep pretending the floor is solid because the wallpaper still looks expensive. You can wait for permission from institutions already trapped by their own arithmetic. You can hope the fault line closes on its own, that the reserve mask is just a technical phrase, that central bank gold buying was a fad, that sovereign selling means the thesis died, that oil shocks are temporary, that debt can keep growing without credibility consequences, that every crack in the dam is cosmetic. You can believe all of that if it comforts you, or you can accept the harder truth. The fault line is real. The shift has already begun. And the price at which you understand that truth will determine the quality of the next decade of your financial life. I am not asking you to panic. I am asking you to stop outsourcing your judgment to people whose incentives depend on keeping the public calm until the expensive part is over. Write this down if you have to. What in my portfolio is built for growth? What in my portfolio is built for reserve truth? What in my life forces me to trust perfect policy outcomes? What part of my wealth exists outside those promises? If you cannot answer those questions clearly, then the fault line is already controlling you. If you can answer them, then the reset will not own you. It will refine you. That is the threshold. Not whether gold rises tomorrow morning. Not whether some commentator calls a top or a bottom. Whether you are still a passenger inside a debt-dependent monetary structure, or whether you have finally begun acting like a steward of your own reserves. One identity waits for reassurance. The other builds through the crack. Choose carefully. The market will not pause while you decide.